invests into is different than what LA invests into. Okay, what Mission does and what you do, there might be some parallels, but they're a different type of operation. You're not that smart either, right?
They're very smart.
Yeah, say hi to Ted. He's watching probably. Leo.
Yeah, of course, that's a different topic, but the venture capital firms are different, I would say, depending on the region, right? In fact, that brings me to another topic, which is another thing my partners and I have been talking about. You've all heard of this, probably, if you've been around venture capital in the last few years, this concern that the venture capital model is broken, whatever that means. And what most people refer to is the fact that the returns have been so poor in the past 10 years, which is true. I actually think, and I haven't fully explored this with my partners yet, but I actually think one of the problems is the fact that we syndicate deals. And it's a fairly complicated rationale, so I'll try to just give you the high level. But what happens as a result of us syndicating deals, meaning venture capitalists never fund the company from start to IPO, or almost never. Right? They bring in lots and lots of capital along the way. And the reasons for doing that, I won't go into right now here, but I think the reasons have become obsolete. And as a result, though, one of the big issues what you have is when you start a company or you decide to fund a company as a VC, you not only have to think, is this a good deal, but you have to think, will other people think it's a good deal? Right? So you have to kind of double think it. Because if you do a deal and other people don't think it's a good deal, you can't raise follow-on capital, even if it is a good deal. And so, as a result, what we have is, and it's in LA as well as any other part of the US, what you have is VCs all focusing on 2 or 3 quote hot sectors. And people from the outside always say, why are venture capitalists so stupid? They over-invest in the hot sectors. But there's actually structural reasons why that's the case. Because if you are in a cold sector, unpopular sector, it's hard to raise money. In fact, it's even worse. It's one thing to be in an unpopular sector. It's another to be in an unknown sector. No one wants to invest in a brand new sector. A lot of people say, well, our VCs aren't investing in innovation. Well, that's somewhat true. And the reason is they don't want to. They want to invest where everybody else has already invested, where there are a whole host of acquirers who can buy the companies once you build them. And this notion, as a result of doing syndicated investing, I think has led to the concentration of money in a few pockets. At an event the other day, I was on a panel of, the moderator gave us a poll, how many like cloud computing? Everybody raised their hand. How many like mobile? Everybody. How many like online gaming? Everybody. There was no difference of opinion. And that's, I think, a lot of the reasons because of what I just talked about. So one thought I have is that what venture capitalists could do, and they're actually moving in the opposite direction, is what they could do is have bigger funds, invest in a concept, and take that through as far as they can, if, maybe up to some reasonable amount, $50 million. So you have $1 billion fund and invest in 20 companies up to $50 million, for instance. I think that would solve some of the problems. The reasons, as I said, I'm not going to go on all of them, but one of the reasons people say VCs should not do that is they need to diversify. But I wonder if maybe you have your limited partners diversify by being in a number of different funds, and the venture capitalists themselves concentrate on a few companies. By the way, venture capital is one of the few, the only one I can think of off the top of my head, industries that actually does this, where they invest and then they won't invest anymore unless they get other people to invest with them. If the LBO world, for instance, they love to invest all the money in the company and take it to IPO or take a private back IPO. They don't like the idea of bringing in other people because they find it difficult to work with another capital provider who might have differences of opinion about what to do with the company. So as I said, this is the opposite of what's actually happening, because venture capitalists today are actually shrinking the size of their funds, and they're investing more like super angels, a little bit of money with a bunch of other people and see where it can go.
How do you then look at like a Horowitz and Andreessen, where they're building these new funds. Now, there's rumors of a third fund that they're even looking at, even after the second one's being formed right now. And these are large funds, 600 million.
Yeah, I think that's actually a good idea, what they're doing, having a bigger fund so you can put more money to work in the winners. But they're not actually deploying the capital that way, as far as I can tell. They're syndicating like everybody else.
Got it.
And by the way, as I know there's a lot of entrepreneurs here, one of the worst parts of syndicating a deal, and I think about this a lot because I'm an early stage investor, is when you syndicate, you have to educate all the prospective guys who you're approaching for money about what you're doing. And you can't just go to one investor and assume that person's going to invest. You have to go to 10 or 15 or 20. Then your PowerPoint gets disseminated among 100 other people. And then if the VCs really like your deal but can't get in it because there's not enough opportunity, they'll fund the next marginal player, and so on and so on and so on.
Let me ask you a question. Who here is part of Technos Angels? TCA. Anyone?
Back there.
One back there. Okay, TCA over. Hey, who here does investing? Actually does angel beginning investing. So a few here. Let me ask real quick, Morgan. Do you follow a VC, or are you before? Are you the angel, pre-rev? I mean, where do you like to go? It's not just the VC. Friends and family. Friends and family. Doug, how about you?
I like to be ahead of the VCs because I have a lot of VC relationships, and so I go in first.
Head of the VCs.
And then try to raise the VC round.
Very cool. I like that.
Yeah.
Just curious.
On the angel front, by the way, there's been a whole lot of activity this year. Some of you probably are participating. It's what they call super angels, or angel syndicates that raise so much money they bypass the first venture round. I actually think that's great for the venture industry, though a lot of VCs don't like it. The reason I like it is because that first round is usually a really tough round.
Yeah.
And you put in money, and 99% of the time it doesn't turn out the way you want to. But if it does start to do well, the angels usually can't put in enough money to make the company grow, so the venture capitalists can come in. I think what it does is it just plants a lot more seeds that then can potentially bring about a larger number of attractive companies down the road. Lastly, I thought, I love interesting financial statistics. This was the year of gold, as you all know. It's funny, I watch a lot of late night TV. And 5 years ago, all the ads were DiTech lending and how you can take money out of your house and it's like an ATM. I mean, if you look back at those ads now, they almost look like spoofs, right? Considering what happened. But right now, what are all the late night ads? They're all gold, right?
Silver.
Yeah.
Glenback and gold.
And silver's coming up. Here's one of the things I like to do as an investor is always look at relative valuations, because I think that can be very helpful in trying to sense is something over or undervalued. So gold, here's something that I think it was Morgan Stanley put out a few weeks ago. If you took all the gold in the world in 1970 and the value of that, and you compared it to the total value of the U.S. stock markets, all the different exchanges, gold represented around 15% of the value of the U.S. stock markets. By 1980, that same statistic, gold represented 170% of the value of the U.S. stock market, which showed you two things. Gold had gone way up. Historically, if you adjust for inflation, it's higher then than it is now. And the U.S. stock markets had collapsed in the 70s. By 2000, gold was down to 15%, back to the old ratio. And today, it's about 60%. And so the really interesting thing is the statistic moves so much you don't know what equilibrium is, but 60%, at least as far as this analyst thought, was still maybe undervaluing gold. And so it has a little bit more ways to go, especially as the U.S. currencies get debased. Last thing, Netflix joined the S&P 500.
But knocked off the New York Times.
Yes.
That was
yes.
interesting.
Which I love. One of the things that's great about the industry of startups is a company that was, in 2000 was just a small little operation is now among the giants of U.S. corporations in terms of market cap. Ken, I think that's it.
All right, William Quigley.